Hello, everyone, and welcome to Chapter 14, Performance Measurement. So we will be looking at explaining and applying the comparative analysis. We'll look at calculating and interpreting ratios that are used to analyze liquidity, to analyze solvency and profitability for the business, along with the limitations that these financial analyses present. So your comparative analysis. So making comparison about a company's past and current financial performance and position to better determine the future expectation. The financial data as well as the non-financial information that is found in the annual reports should be reviewed. So items such as the company's mission, what's their strategy, what are the goals and objectives that they are looking to achieve, and look through the MD&As, which is the management discussion and analysis. So there are various types of analysis that can be done when it comes to financial data. The very common types are the horizontal and the vertical analysis. This is also called as trend analysis. So basically, it's a technique to express the change over time, and it can be expressed as the amount of percent, which is percent of the base period amount or the percent of change for the period. There are very good examples in the textbook, and I highly recommend that you refer to that portion for the horizontal as well as for the vertical analysis. So this is also known as the common size analysis, which is a technique that expresses each item in the financial statement as a percent of total, which is the base amount, which is the total asset or net sale. The comparison of the data is within the same year and it's expressed as a percent. So the vertical percent of base amount is the analysis amount over the base amount. Once again, do make sure to review this information in your textbook as well. So there are three types of comparisons that the companies can do. One is the intra-company, which is within the company from one period to the other. There can be intercompany, which is the comparison between one or more competitors or the companies. And we can alternatively look at industry averages to compare the performance of different companies. So when it comes to the ratio analysis, there are three broad categories of the ratios. There is liquidity ratios, solvency, as well as profitability. So liquidity ratio is a short-term measure, which basically measures the company's ability to pay its maturing debt to meet the unexpected need of cash. So this is on the short-term time horizon, and that's why it's called as liquidity ratios. There are a bunch of ratios, and we'll look at them in just a little bit here. On the other end, we have our solvency ratios, which is a measure the ability of a company to survive over a long period of time and the ability to pay its total liabilities. So solvency ratio is looking at the longer term perspective of the company. Does the company have the ability to stay afloat in the long term? And then we have the profitability ratios, which basically is the measuring the operating success of the company for a specified period of time. So for the liquidity ratios, which is for the short term, we look at some of the common ratios, which is current ratios, receivable turnover, average collection period, inventory turnover, and days in inventory. So your current ratio is your total current assets divided by your total current liabilities. This measures the short-term ability of the company to pay its debt. Usually the current ratio is checked by the vendors. The vendors want to know if the company does have the ability to pay its short-term maturing debt. Okay, so if you think the accounts payable is sitting in your current liabilities, so the companies or the vendors want to make sure the company does have the ability and resources to pay those maturing debt. Now, generally speaking, higher the number, the better it is, but that always is not the case. Generally, we want to have this number closest to 1. Anything over 1 is not very healthy for the company either. From the vendor's perspective, it might be a good idea, but from the company's perspective, it might not be. So it depends on who is looking at that ratio. So the next one we are looking at is the receivable turnover. Receivable turnover, we want this one to be higher the better. Okay, so this basically is your net credit sales divided by your average gross receivable. And by average, we mean beginning plus ending divided by 2. So basically, this is telling the company how many times in a year are they able to convert their receivable into cash. So you want this to be higher, but not significantly higher once again. So it's just more of a judgment call. There is your average collection period. So we were looking at the receivable turnover. So receivable turnover tells you the number of times you are able to convert the receivable into cash. Okay, so let's say if this ratio was 12, that means 12 times in a year the cycle is completed between receivable to cash, receivable to cash, receivable to cash. So 12 times in a year the company is completing that cycle. But what does that mean in number of days is what your average collection period is, which is more meaningful. So we take 365 days in the calendar year and divide that by your receivable turnover ratio that was calculated. So this will tell us on average how many days does it take for us to convert our receivable to cash. So technically speaking, if your receivable is turning 12 times in a year, then that must indicate that your average collection period is about 30 days. Okay, so we want our collection period to be lower, but again, significantly lower could also pose some challenges. The other one we look at is inventory turnover. Inventory turnover is a similar concept to receivable turnover. Now, keep in mind when the companies manufacture or produce this inventory, their intention is to sell this inventory to make money. So we want to know how often is the company actually able to convert that inventory to cash. So that is what the inventory turnover ratio is. This is cost of goods sold divided by average inventory. Once again, average is your beginning inventory plus ending divided by 2. So we want this number to be higher the better as well. And if we want to know exactly what that means in number of days, how many days is it taking for us to convert that inventory to cash, then we look at days in inventory ratio, which is 365 days divided by inventory turnover. So these are all the liquidity ratios that we will be discussing in this example in E14-5 in class. Solvency ratios, as we said, is the long-term outlook from the company. So the general lenders, such as your banks, want to make sure that the company does have the ability to stay afloat on a long-term time horizon. So we have listed 3 ratios here, but we will not be discussing free cash flow. We are only discussing debt to total asset and times interest earned. So debt to total asset ratio is your total liabilities, meaning that it includes your current liabilities as well as your long-term liabilities. And your total assets is all your asset base, whether that is your current asset, PP&Es, intangibles, goodwill, every asset that you can think of is your total asset. So if we take our total liability and divide that by the total asset, that is what our debt to total asset ratio is. So this measures the percent of total assets provided financed with debt. Okay, think of it this way. When you have a car is an asset, and if you have financed that car, there is a liability attached to that. So with this ratio, we are trying to determine what percent of our assets have liabilities attached to that. So we want this to be lower the better. That means the company is more solvent. If this number is lower, then that's better. We want lesser liability, higher assets. So the way to remember that is we want our denominator to be a higher number, so a lower ratio would be preferred here. Times interest earned, this one is quite an interesting ratio and is quite widely used. So this measures the ability to meet the interest payment as they come due. The companies have to make sure they have enough resources and money to pay their interest payment. So we look at our net income plus the interest expense plus the income tax expense. So basically we call it earnings before interest and taxes. That is what EBIT is. Earnings before interest and taxes divided by your interest expense. What we are trying to determine here is, does the company have enough ability to generate money in order to meet their maturing interest expense obligations? Okay, because failing to pay the interest can push the companies into bankruptcy. So we want this to be higher the better. And as we said, we are not discussing free cash flow. That is not needed for this course. So in the example E14-8, we will be discussing about the solvency ratios. Then comes your profitability ratios, but here we are just discussing the first 5. Your gross profit margin, asset turnover, return on asset, and your return on common shareholders' equity. So your gross profit margin, so these ratios are generally looking at the overall profitability of the company. So this measures the margin between the selling price and cost of goods sold. So cost of goods sold is the cost associated to your sales and the selling price. So we take our gross profit. Now gross profit is your sales minus your cost of goods sold. So that gross profit divided by your net sale gives you your gross profit margin. We want this gross profit margin to be higher the better. Okay, but at this point in time with the gross profit margin, we are strictly looking at the selling price and the cost of goods sold. Another variation of this ratio is the profit margin, because with the profit margin, we are looking at net income. If you recall with the earlier one, the gross profit was sales minus your cost of goods sold. We had not adjusted for operating expenses there. But net income is after everything. So it does account for your operating expenses here. So your net income divided by net sales is what your total profit margin is. That is what we are left with, the profit that is generated by each dollar of sale. So we once again, if any profit margin or the gross profit margin, we want these to be higher, the better. Asset turnover ratio is to see how efficiently the business is using their asset to generate sales. Keep in mind when the business is buying more assets, property, plant, equipment, or intangibles, their whole intention is to use these assets to generate more revenue. So this ratio will tell us if that actually is the case. Okay, is that intention actually working out? So we look at net sales divided by our average total assets. So average total asset is beginning total assets plus the ending total asset divided by 2. Once again, we want this to be higher the better. Return on assets. Your return on asset is how much is earned on each dollar that was invested in the asset. So we take our net income and divide that by our average total assets. We want this number to be higher the better as well. And the last one that we are looking at here is the return on common shareholders' equity. So this will measure the overall profitability of the shareholders' investment. So we look at return on common shareholders' equity, which is net income, minus the dividend declared for preferred shareholders, divided by average common shareholders' equity. We want this number to be higher, the better once again. We will discuss all of these ratios with regards to profitability in E14-11. And that is all we have for chapter 14 here.